Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing the past 30 days in 3 minutes. The S&P 500 was down 4.1% during August, but that doesn't tell the full story. Markets initially rallied during the first half of the month, with the S&P gaining 4.2% as July's rally continued. However, the second half of August marked a sharp reversal as the S&P gave back all of its gains plus some. Credit markets also experienced a reversal as interest rates increased and bonds produced negative returns. This renewed volatility across stock and bond markets is being attributed to a wide range of investor views, creating a tug-of-war effect in markets, as well as uncertainty regarding how long the Federal Reserve will continue to raise rates. During the Fed's annual Jackson Hole meeting, Chair Jerome Powell forcefully pushed back against the notion the Fed will pivot and cut rates if economic data starts to weaken. He emphasized the central bank's, quote, overarching focus right now is to bring inflation back down to our 2% goal, end quote. And then he cautioned, quote, reducing inflation is likely to require a sustained period of below-trend growth and will bring some pain to households and businesses, end quote. Investors' hope for a Fed pivot were one of the primary catalysts that propelled the markets higher this summer, and Powell's speech dashed those hopes and sent the S&P down more than 3% on the day of his speech. Why? 2 lines from his speech underscore the Fed's goal. Quote, there is clearly a job to do in moderating demand to better align with supply. We're committed to doing that job, end quote. This focus on lowering demand for goods and services may increase portfolio volatility during the months ahead as investors debate how long it will take the Fed to achieve its goal and the impact tighter policy will have on the economy. Last month, I mentioned we experienced 2 consecutive quarters of negative GDP and referred to it as a technical recession. However, it's not really a recession until a determination by the National Bureau of Economic Research is made after considering a wider range of factors such as productivity, job market, and wages. Considering the strength we're seeing in those areas, most economists do not believe the U.S. has entered a recession. But looking ahead, we're keeping an eye on 3 leading indicators which are starting to show warning signals. The short-term inverted yield curve, a declining Conference Board leading economic index, and rising initial jobless claims. The next couple of months will be important in determining whether these trends are sustained. And although they help paint a picture of how the economy is holding up, none are flashing red, but could indicate more challenging growth conditions in the months ahead. It's also worth noting that none are perfect recession forecasters, which for investors does not mean allocation shifts within their portfolios. The stock market is a discounter of future growth conditions, and it's very possible that the drawdown in the first half and the ongoing choppiness today is the market pricing in this economic weakness. By the time a recession arrives, if it ever does, the market may have already moved on. Again, we thank you for your trust and confidence.